Most people believe saving money is always smart. They cut expenses, avoid risks, and feel responsible. But saving without investing strategically can quietly destroy your financial future. Inflation reduces purchasing power every year. If your money is not growing faster than inflation, you are slowly losing wealth without noticing it. Keeping large amounts of cash in low-interest accounts feels safe. The balance looks stable. There is no volatility, no stress. But stability can be deceptive. When returns stay below inflation, your money loses real value. Safety without growth becomes a hidden risk over time. The biggest investing mistake is confusing saving with wealth building. Saving protects money temporarily. Investing multiplies it. Protection alone cannot create financial freedom. Growth is essential. Without growth, your effort remains limited by time and income. Many people delay investing because they wait for the perfect moment. They want certainty before acting. Markets, however, reward consistent participation, not perfect timing. Waiting often costs more than starting imperfectly. Time in the market matters more than timing the market. Fear of loss prevents action. Headlines highlight crashes and downturns, creating anxiety. Yet avoiding all risk guarantees stagnation. Calculated risk, managed wisely, is necessary for growth. Refusing to invest is itself a long-term financial risk. Another mistake is holding money without a clear strategy. People save randomly, invest occasionally, and react emotionally. Wealth builders follow structured plans. They allocate assets deliberately, diversify intelligently, and rebalance consistently. Strategy reduces stress and improves long-term outcomes. Some believe investing requires large capital. They wait until they have enough. In reality, starting small builds habits and experience. Compound growth rewards time more than size. Even modest contributions, invested consistently, can grow into significant wealth over decades. Trying to predict short-term market movements often leads to costly errors. Emotional buying and panic selling destroy returns. Long-term investors focus on fundamentals, not daily no's. Discipline protects capital better than constant reaction to temporary fluctuations. Oversaving in cash creates opportunity cost. While money sits idle, productive assets grow elsewhere. Businesses expand. Real estate appreciates. Markets compound. Missing these cycles reduces potential wealth. Opportunity cost is invisible but extremely powerful. Many avoid investing because they fear complexity. Financial terms sound intimidating, but complexity decreases with education. Understanding basic principles, diversification, risk management, long-term growth creates confidence. Knowledge transforms uncertainty into calculated decision-making. Another hidden mistake is chasing guaranteed returns. High guarantees often hide high risk. Truly wealthy investors understand that reasonable, steady growth over time is more reliable than promises of fast profits. Patience consistently outperforms excitement. Some people invest emotionally based on trends or hype. Social media enthusiasm pushes them into assets without research. By the time excitement peaks, prices are often inflated. Wealth grows through analysis and discipline, not through following crowds. Ignoring diversification increases vulnerability. Placing all money into one asset, company, or sector concentrates risk. If that single choice fails, progress collapses. Diversification spreads exposure and stabilizes long-term performance across economic cycles. Failing to reinvest profits limits compounding. Spending gains immediately stops exponential growth. Reinvesting earnings allows capital to multiply itself. Compounding is slow at first, then powerful over time. Interrupting it delays financial independence. Many underestimate the impact of small fees. High management costs, frequent trading, and unnecessary commissions quietly reduce returns. Over decades, even minor percentages compound against you. Controlling costs protects more wealth than chasing higher returns. Another mistake is focusing only on income instead of assets. A high salary feels secure, but income depends on continuous effort. Assets generate returns independently. Wealth grows when money works for you, not when you work endlessly for money. Some people wait until they feel financially comfortable before investing. Ironically, investing is what creates comfort. Delaying participation reduces the power of compounding. Starting earlier, even imperfectly, builds momentum that late starters struggle to match. Emotional reactions during market downturns destroy long-term progress. Selling in panic locks in losses. Markets historically recover, but only patient investors benefit from that recovery. Discipline during volatility separates builders from spectators. Another mistake is lacking clear financial goals. Without defined targets, investment decisions become random. Goals create direction, time horizons, and risk tolerance. Clarity transforms investing from guessing into strategic execution. Finally, believing that saving alone guarantees security is misleading. Security comes from growth, diversification, and adaptability. True financial stability is built through intelligent investing, consistent contributions, and long-term thinking, not simply storing cash. Many people keep increasing their savings rate but never upgrade their investment knowledge. They assume more cash equals more progress. In reality, smarter allocation often matters more than larger deposits. Efficiency multiplies effort. Another common mistake is investing without understanding risk tolerance. Taking excessive risk creates panic during downturns. Taking too little risk limits growth. Balanced allocation aligned with personality ensures consistency through market cycles. Some confuse activity with progress. Frequent trading feels productive, but constant adjustments increase fees and mistakes. Long-term strategies usually outperform restless movement. Patience often produces stronger returns than action. Ignoring tax efficiency reduces overall performance. Poorly structured investments lose unnecessary capital to taxes. Smart planning preserves returns and improves compounding over decades. Lastly, failing to review and adjust portfolios leads to imbalance. Markets shift, goals evolve, and allocations drift. Periodic rebalancing maintains alignment and protects long-term objectives. Another mistake is investing without an emergency fund. When unexpected expenses appear, people are forced to sell assets at the worst possible time. A financial cushion protects investments from disruption and keeps long-term plans intact. During short-term stress, some investors compare their progress constantly with others. This creates pressure to chase higher returns or riskier assets. Financial journeys are personal. Competing with someone else's timeline often leads to reckless decisions and unnecessary losses. Ignoring inflation when planning long-term goals weakens results. What seems like enough today may be insufficient tomorrow. Investments must outpace inflation to maintain real purchasing power and protect future lifestyle expectations. Another issue is underestimating the power of consistency. Irregular contributions slow growth dramatically. Small, predictable investments made regularly often outperform large, inconsistent deposits made occasionally. Finally, failing to document a clear investment plan invites emotional decision-making. Written rules reduce impulsive reactions and provide structure during uncertainty. A simple plan executed consistently beats complex strategies abandoned midway. Many people underestimate how powerful time truly is. They focus on short-term results and become discouraged when growth looks slow. Early stages of investing rarely feel impressive, but compounding accelerates later. Quitting too soon destroys the exponential phase that creates real wealth. Another mistake is ignoring asset allocation. People obsess over picking the best stock while neglecting overall portfolio structure. In reality, allocation between stocks, bonds, real assets, and cash often determines long-term performance more than individual selections. Some investors react to every headline. News cycles amplify fear and excitement. Constant reaction creates instability. Long-term investing requires filtering noise and focusing on fundamentals. Emotional responses to temporary events reduce clarity and discipline. Overconfidence can be as dangerous as fear. A few successful trades may create the illusion of skill. Without proper risk management, confidence turns into concentration risk. Sustainable wealth comes from controlled exposure, not unchecked optimism. Failing to track performance objectively limits improvement. Without reviewing results, mistakes repeat silently. Honest evaluation strengthens strategy. Data reveals weaknesses and highlights strengths. Reflection turns experience into measurable progress over time. Another common mistake is investing without understanding the underlying asset. Buying something simply because it performs well ignores its fundamentals. When volatility appears, confusion replaces confidence. Knowledge builds conviction. Conviction prevents emotional selling during temporary downturns. Many people treat investing as secondary to spending. They save what remains after expenses instead of investing first. Reversing this order changes outcomes dramatically. Paying yourself first ensures that growth becomes a priority, not an afterthought. Some underestimate the importance of patience during flat markets. Not every year delivers strong returns. Periods of slow growth test discipline. Staying invested during calm phases allows participation. When momentum eventually returns, another error is relying entirely on others. Without personal understanding, advisors can help, but blind trust removes responsibility. Basic financial literacy empowers better questions and smarter oversight of your own capital. Finally, believing that investing is only for the wealthy creates self-limiting beliefs. Wealth is often the result of investing, not the prerequisite. Consistent action, education, and discipline transform ordinary savings into long-term financial strength. Many people reinvest inconsistently. Dividends, interest, or profits sit idle instead of being redeployed. Idle capital slows compounding dramatically. The habit of reinvesting automatically magnifies returns over decades and accelerates wealth creation without additional effort. Another mistake is avoiding risk entirely. While fear of loss feels safe, it prevents growth. Controlled risk, managed according to goals and capacity, is essential. Avoiding all risk guarantees stagnation and missed opportunity over the long term. Some people let lifestyle inflation consume extra income, raises, or bonuses go to spending rather than investing. This habit creates the illusion of financial growth, while actually limiting long-term wealth accumulation. Wealth grows when capital grows first. Failing to set clear goals reduces discipline. Without a target, contributions and allocations are random. Goals create focus, urgency, and metrics to measure progress. Clear objectives transform routine, investing into strategic wealth building. Many underestimate the compounding effect of small, repeated improvements. Tiny gains in returns, savings rate, or efficiency may seem negligible. Over decades, these small edges create massive differences between average and exceptional financial outcomes. Another mistake is reacting to market hype. People buy trending stocks or funds based on excitement rather than analysis. Chasing short-term fads often leads to buying high and selling low. Disciplined, long-term focus outperforms impulsive trends consistently over time. Some investors ignore diversification across sectors and asset classes. Concentrating wealth in a single area exposes capital to unnecessary risk. Spreading investments reduces volatility, protects against downturns, and allows smoother growth across cycles. Finally, failing to start early is the most costly mistake. Every year of delay reduces the power of compounding. Starting small today beats waiting for the perfect moment tomorrow. Time in the market, not timing it, is the true secret to long-term wealth.